As a founder, you never want to lose sight of that big vision that you set for yourself when you started the company, which is to build that iconic success. So, in our picture here, IPO. Very important to never lose sight of that. However, as we talked about earlier, you want to break the journey into a series of interim milestones and phases. Conveniently, it makes it a little less overwhelming at times as a founder, and it actually aligns with how investors think about financings. So if you notice in our chart here, valuation increases in a step function. Not linearly, but in a step function. And valuation is tied directly to achieving milestones. So one of the jokes we make at Unusual Ventures is, getting 80% of the way to the moon doesn't do you any good. And what we mean by that is, if you get 80% of the way to your milestone at any phase in the journey, notice how your valuation doesn't increase. So you want to raise enough money to make sure that you achieve the milestones you've set at each phase, but not so much money that you diluted yourself or sold too much of the company. So let's be more specific. We use 3 basic categories to describe the interim milestones that you want to set at each stage: team, product, and traction. Team represents the hires that you want to make during that phase of the journey. Product is the functionality that you want to release during that phase of the journey. And traction is the existence proof or customer validation and how it will be measured at that phase of the journey. So whether you're starting your company and it's a pre-seed, or you're on your way early, you're raising a seed, or even a Series A or a Series B, it's best to organize your interim milestones by team, product, and traction. And you raise the amount of money for the time frame that you need to achieve those milestones. And that aligns nicely with how investors think about funding companies and the inflections in valuation that happen when those milestones are attained.